You know, on Wall Street, there's a name that feels less like a financial firm and more like a secret society. They're famously brilliant, incredibly profitable, and almost completely silent. That name is Jane Street. And today, they find themselves at the center of a massive global controversy that could honestly rewrite the rules of the game.
So that brings us right to the big question we're tackling. Are they simply the smartest people in the room, providing that essential grease that keeps markets moving? Or are they using that genius to rig the whole system? It's a question that regulators in India and crypto traders all over the world are demanding answers to. Okay, so before we dive into the accusations, we really need to get a handle on who we're even talking about, because Jane Street is not your typical Wall Street firm, not by a long shot.
I mean, Jane Street feels less like a bank and more like a university's math department that just happens to print money. They use the super rare programming language called OCaml, they operate with almost no managers, and they've built this intense culture of learning. They even sponsor a huge math prize for girls. Now, this isn't just a fun quirk, it's central to their whole strategy. It's how they attract these unconventional minds who can operate right on the edge of finance. They really are, in every sense of the word, a Wall Street anomaly. And believe me, this unique approach is wildly successful. Just to give you a sense of scale, Jane Street reportedly pulled in over $4 billion in profit from its trades in India just last year. But here's the thing. When you make that much money that quietly, you're eventually going to attract some attention. And in Jane Street's case, that attention has come in the form of some very, very serious accusations. All right, let's get into the first major charge against them. This one comes from India's top securities regulator, a group called SEBI. And they believe they've uncovered a deliberate manipulative strategy. SEBI basically laid out this four-step playbook they allege Jane Street used. You can think of it as a kind of financial pump and dump, but on a massive institutional scale. First, they use their immense capital to drive prices up. Second, while that's happening, they place this huge bet that prices will fall, what we call a bearish position. Third, they pull the rug out from under the market, selling everything to trigger a crash. And finally, step 4, they cash in on that bearish bet they made earlier. And we're not just talking about being a big player here. SEBI claims that for a time, they pretty much were the market. On one of the days in question, Jane Street's trading allegedly made up a whopping 25% of the entire market's traded value for some of India's biggest bank stocks. So what was the result of this whole four-step plan on just a single day in January? A staggering net profit of $77 million. And this right here gets to the absolute core of SEBI's argument. They point out that Jane Street actually lost $7 million on the stock trades. But you see, that was just the cost of doing business. That was the price of admission. By engineering that crash, they made over $84 million on their options bets. It was a calculated loss specifically designed to set up a much, much bigger win. And this wasn't just happening in India. Over in the crypto world, traders started noticing this weirdly regular pattern, a massive dump of Bitcoin right around 10 a.m. Eastern Time, just as the US markets open. It would liquidate traders, push the price down, and then maybe it would recover. The parallels to what was happening in India, they were pretty hard to ignore. But, of course, there are two sides to every trade. So now, let's look at Jane Street's side of the story. They argue this wasn't manipulation at all. It was just a perfectly legitimate, if, incredibly complex strategy. Their entire defense really boils down to one word: arbitrage. It's one of the oldest trades in the book, right? Imagine you find a concert ticket for sale for $50 on one website, and at the exact same time, you see someone is willing to buy it for $60 on another site. You buy it and sell it instantly, and you pocket that $10 difference, risk-free. Jane Street is basically saying they were just doing a super high-speed, high-tech version of that. So how in the world does arbitrage apply here? Well, their argument is that you can own an asset in two different ways. You can go out and buy the stocks directly, pretty straightforward, or you can create what's called a synthetic version by carefully combining different financial instruments called options. Now, the methods are totally different, but the financial outcome is designed to be pretty much identical. And this is where they say the opportunity was. According to some great reporting from Bloomberg's Matt Levine, on that specific day in January, the price of the synthetic index, the one in the options market, was about 1.6% higher than the price of the actual stocks. The market was just out of whack. So Jane Street's defense is pretty simple when you break it down. They saw a classic arbitrage play. They bought the index where it was cheap in the stock market, and at the same time, they sold it where it was expensive in the options market. They claim they were just correcting a price mismatch, which is the fundamental job of a market maker, right? To provide liquidity and keep prices where they should be. So this leads us to the real heart of the mystery. Was it a crime, or was it just a really clever trade? The line between finding an edge and creating one starts to get incredibly blurry here. What you have are two completely opposite interpretations of the exact same set of trades. SEBI sees this malicious plot to tank the market for a profit. Jane Street sees a routine arbitrage trade, where buying the stocks was just a necessary hedge, basically a way to balance out the risk of their options position.
But here's where that whole arbitrage argument starts to get a little shaky. For a true arbitrage, or a true hedge, you'd expect the buy side and the sell side to be roughly equal in size, right? Well, the data from SEBI's report tells a very different story. Get this. On that day, Jane Street bought about $500 million worth of the actual stocks. But their bet against the market, using options, was equivalent to selling $3.7 billion worth. That is more than 7 times larger. For critics, this imbalance is the smoking gun. It doesn't really look like a balanced hedge at all. It looks like a massive, aggressive bet that the market was going to fall, and the stock purchases were just a tiny part of a much, much larger scheme.
So where does that leave us? What can we conclude? Well, the truth is, the full story is locked away inside Jane Street's secret algorithms, inside what they call their black box. And we know just how valuable these secrets are because of a whole separate lawsuit. Jane Street sued 2 of their former traders to stop them from taking a strategy to a competitor, and in those court documents, it was revealed that this one single strategy, focused on Indian options, generated $1 billion in profit in a single year. And the details of how it works, all redacted, sealed by the court. And that leaves us with this final and, I think, crucial question. In a world where trading happens in milliseconds, driven by incredibly complex code that almost nobody understands, is there even a meaningful difference anymore between finding a market inefficiency and actively creating one for your own profit? That's the billion-dollar question at the heart of the Jane Street Enigma.